So, thank you for the lamp lightning. And our guest of honor, Rajeshwar Rao, Deputy Governor, Reserve Bank of India, followed by Professor Debashis Chatterjee, the Director, Mr. Murali Ramakrishnan, MD and CEO of South India Bank, Mr. Ravi Mohan, Chairman, ESAF Small Finance Bank, Mr. George Alexander Muthoot, MD, Muthoot Finance. Thank you, all of you, for coming here and doing the lamp lightning. I forgot Mr. Shyam Srinivasan. We treat him as part of the IIM. I mean, he has been so kind to us. And I mean, he's the person who has been leading the Federal Bank since 2010, and amongst the leaders who digitally transform the banking here in Kerala. And he has got awards as a distinguished banker, so we very much appreciate. Mr. Murali Ramakrishnan, known for sort of turning around a weak bank. Mr. Ravi Mohan has been on the regulatory side of the fence long back, and then had joined an IMF training institute, and has conducted FSEP assessments, is now heading a small finance bank as a chairman. Mr. Murali Ramakrishnan had a distinguished career with ICICI Bank, and he then moved on to turn around the South Indian Bank in particular. So about Deputy Governor, let me just say one thing, that he became the Deputy Governor in 2020, and we had a relationship for 4 decades, 3.5 decades or so. I've worked under him, and it has been a pleasure working under him when I was heading the international department of the bank. And he has several other portfolios, which I need not mention for want of time. But I must tell you, he has one of the most onerous tasks on his hand. His prime job is to save the banks, the Indian financial system, the government, and the people of India, all of them at one time. And most of whom are small savers. So he has to protect them. And that leaves him with little option but to do the task without worrying about pleasing his stakeholders. He can't please everybody at one point of time. You would know that the government of India has spent over 3.8 lakh crores in recapitalization of Indian banks in recent years. And only with good regulation we can be able to kind of save the fiscal burden, which is ultimately burden on us. Professor Debashis Chatterjee, thank you in particular, because I stole your holiday time. Your family is here. And that's really an honor that you have come here just for this. And his astonishing insights on leadership are reflected in his leadership program. All of us know about that. He is also credited for steering IMK to higher rankings among the business schools. But what charms the most is his prolific writing, as he has authored several books. We all know and we have read them. So over to you, to Director, for your welcome remarks. And then.
Good morning. Barely a murmur. That's not what it is. We don't murmur. We wish people that are here. First, let's hear a very good morning, which is hearty and audible. Can we hear that? No, not quite. That's not quite. Good morning. Yeah. Is this what an organization is all about? One person shouting good morning. Can we do it together? Well, 1, 2, 3. Good morning. Yeah, that's a little more encouraging. This morning, finance guys, put us to sleep anyway. So we have to cheer them up. Let me first welcome IIM Rajeshwar Rao, Deputy Governor, Reserve Bank of India, for accompanying this star cast of bankers, and for accepting our invitation to visit our campus to deliver the inaugural address at the first annual seminar of the Indian Institute of Management Kozhikode on banking, regulation, intermediary soundness, and systemic stability. That's quite a mouthful for a non-banker. Nevertheless, your inaugural address, Mr. Rao, is keenly awaited and will set the tone for our seminar. Let me also, in random order, welcome Mr. Ravi Mohan, Chairman of ESAF Small Finance Bank, Mr. George Alexander Muthoot, MD of Muthoot Finance, Mr. Murali Ramakrishnan, MD and CEO of South Indian Bank, and last but not the least, Kerala's iconic banker, Mr. Shyam, Srinivasan, MD, and CEO of Federal Bank. How can we forget his name? We can't. Thank you for gracing this occasion by coming to our campus. I welcome the very distinguished guests seated here from the banking fraternity, and we look forward to hearing all of you as well. Now it's time for a 16 inches applause, so we warm up the speakers. So can we do that now? Thank you for that. I would like to greet all those who are here to attend the seminar, our PGP and PGP finance students, students from colleges in the city and bankers, Defense Forces students who are coming here, my faculty, my deans, and my staff. I'm happy that Uruppika, which is the origin of the Indian word rupee, that's what I was told, the Center for Excellence in Macroeconomics, Banking and Finance, CMBAF, please put your phones on the silent mode. You can't afford to have them off again because we have a fine of $1,000 each time it goes off. So please, if you haven't done your phone, please put them on silent mode right now. I appreciate that. So this center, led by the mentally young and physically agile and very strong person who you saw just here, Professor Mridul Saggar, he has taken the initiative to organize this seminar at a very short notice. I'm sure the bank heads present today and other diverse stakeholders will join hands to support the center and also benefit from our professors engaged with the center. I'm sure that the center will become a meaningful engine of social change by advancing the knowledge of economics and finance. IIM, as you might know, was set up in 1996 as per the National Institute Ranking Framework. Where is this phone coming from? $1,000, please notice this. I'm going to collect the money when I go out. Please switch your phone. I'm speaking for the last time. Switch your phone off or put it on the silent mode because we want to hear our speakers. Thank you. Appreciate that. We were ranked among the top 3 IIMs of India in terms of NIRF framework. And thank you. And top 75 among global schools based on our open enrollment program. This is Financial Times ranking. IIM Kozhikode has been diligently pursuing the dream of globalizing Indian thought. Our institutional values are Satyam, Nityam, and Purnam. Authenticity, sustainability, and fulfillment. And this, we believe, are also the values underlying financial regulation as a system. Why is that so? When I get the RBI governor's 100 rupees note signed as, I promise to pay the bearer sum of rupees 100, it simply means that I demand from the RBI governor the authenticity, the sustaining power, and the fulfillment that comes with the promise that 100 rupees worth of gold or value worth 100 rupees, not 99, not 10 rupees, will come to me. You can see, and therefore, the central bank that honors authenticity, sustainability, and fulfillment also uses its regulation and supervision activities in search for truth, reality. Without that, you can't have regulation. Financial systems around the world is now also turning green to support sustainability and fulfillment of Purnatva, which is the other name for Purnatva, fulfillment, which is reflected in the central bank's support to ensure systemic stability in the financial system so that the country makes rapid strides in the growth. The A+ rating of RBI governor in the Global Finance Central Bankers Report Cards 2023 is a testimony to great financial leadership of this country. Can we applaud the Reserve Bank of India? In IIM Kozhikode, we articulated our vision for 2047 way back in 2013 through a coffee table book that my colleagues and I co-wrote. we sent this coffee table book to all the chief ministers of the country, the Chief Justice of India, and two of the chief ministers responded very promptly. One had to be our own Prime Minister, who was then the Chief Minister of Gujarat, and the Chief Minister of Bengal, who's still the Chief Minister of Bengal, and both of them had to say great things about 2047. We recognized that we have to ask ourselves that if we want to remain a first world economy, a first world country by 2047, what should we stop doing? We didn't ask what should be doing, but we asked ourselves what should we stop doing for us to remain relevant as a nation. And as a member of the RBI Appointments Committee for Selection of Chairperson of State Bank of India, I learned something very interesting. I learned that the most obsessive focus for recruitment of chairman of banks was this expression called NPA, non-performing assets. Yeah, only in India could we think of that, but anybody who has horse sense will understand that why is something that is non-performing is still being called an asset? Why not a liability? Then I recognized that maybe a better term would be non-performing assumptions behind those assets. And those assumptions had to be challenged. Those assumptions had to be looked at square on the face. Because I wondered how these non-performing assumptions that we had about what banks stood for would make us a more, examining those assumptions will make us a more resilient economy. And so we are looking at this extraordinary aspiration that requires finance to support its growth. We are looking at a sustainable growth. We are looking at not just in terms of greening the financial system, but in terms of keeping macro-financial stability with low inflation. And we see a better developed financial system will spur innovation in this country. And innovation is where we beat poverty, we can beat our problems, we can solve our problems, not through standard processes, but through very deeply innovative ways and methods. And banking regulation is also going to be about saving the poor who have very little finance and very little savings. We don't want a repeat of Lakshmi Vilas Bank anymore, because we know how difficult it is for the poor to reclaim their money. Not just reclaiming the money, but the processes that they go to, the painful processes they have to go through to do that. And so what we need in the banking system is first and foremost a person of integrity in the leadership role. I recall to you a name that most bankers would recognize of this vintage. They recognize the name of Rajkumar Talwar, R.K. Talwar, who was synonymous with integrity in the banking industry. What happened to Talwar? Talwar was the chairman of State Bank of India, and the then government led by the Prime Minister, charismatic Prime Minister of India, wanted Talwar to give away loans, which was not ethical. And Talwar resisted. There was no way to dismiss a SBI chairman, so they invented a new set of rules to dismiss him, or was about to dismiss him when at the age of 56, he retires to Pondicherry, stays in a rented house, which I visited last year to figure out where Talwar was. But I heard something interesting there. I heard that there was a beeline of bankers who was going to meet Talwar. He had no position. He was an ousted chairperson. He was IDBI chair and State Bank of India chair. Yet people would make a beeline to meet him, all kinds of bankers, CEOs. People would come to Pondicherry to meet him. He was a recluse. Right? Why would they want to come to meet him? Because he was an embodiment of integrity which regulators need to have. You can't beat the truth. You can obscure it. You can transfer it. You can browbeat it, but you can't beat it. That's why Satyam becomes such an important issue in the frame of regulation. And so Rajkumar Talwar, who passed away in 2001, he actually died in April 23, 2002. He became an institution unto himself. So when you look at an institution, you will see institutions are not pillars and buildings. Institutions are those people who sustain these institutions. Institutions are a series of leaders. Very often we think institution is an abstraction. An institution runs by itself. But institutions are built by people. They are sustained by people. They are fulfilled by people. And it is those people who are not the pillars of institution end up being caterpillars. They corrode the vitality of institutions. And it takes 1,000 years to build it. It takes just 1 second mishap to destroy it. And so when you look at institutions, we are talking about what is this institution called IIM Kozhikode, which is hosting this conference, what we stand for. What is our role in this? Because this is a bunch of very young MBA students. Here are some insights that I want to share with you. First of all, we are not in the business of graduating MBAs. That is our peripheral activity. Our core activity is to induce you into the romance of creation of wealth. This nation is nothing without creation of wealth. And so how do you create wealth? What is wealth? What is wealth, which we are planning to regulate? What is wealth? We tend to judge, and I have a few insights that I would like to share with you, hard-earned insights from meeting multiple people, taller than me, bigger than me, greater than me, wiser than me. I've learned from them. And here is what I would like to share, particularly for the MBA students. The stalwarts don't need this wisdom, they already have it, but I'm sure the young ones will benefit. We tend to judge people, or you tend to judge wealthy people by what we see in them. Wealth is what you don't see. Wealth is really what you don't see, because wealth is between your 2 ears. What you see are symbols of wealth. What you see are currencies. What you see is the artifact. These are not wealth. These are symbols of wealth. Wealth is conquest of ego. Very ancient wisdom. What is conquest of ego? Wealth is deferred enjoyment. Wealth is about creating a value by suppressing what you could buy today in order to have more options for yourself in the future. It is deferred greed. And if you ask me, what do you mean by deferred greed? You have to remember what one of the world's greatest wealth creators did and said. He said, this is Warren Buffett, he said, the stock market is a device for transferring money from impatient to the patient. And he made most of his money after the age of 65. After the age of 65. So what did he do until the age of 65? He became an investor at the age of 10. So for 55 years, he was deferring what we call symbols of wealth. If you still look at Warren Buffett, you look at his lifestyle, you recognize what wealth creation meant. And therefore, you have to think long term if you have to be a wealth creator. The third insight I have is money is human energy impulse that can be alphanumerically coded on a plastic card and can be transferred. Those impulses can be transferred digitally, provided there are two forces behind the transference. One is value, the other is trust. If you erode value, if you erode trust, this transfer is not going to happen. This digital dance of money will not happen. Because trust and value will be the choreographers of this dance. If you don't have these two, it doesn't matter how much money you have. If you don't have these two, value and trust, you can't be a banker. In the larger financial and regulatory system, you are one person in a game of 7 billion other people and infinite moving parts. The accidental impact of actions outside of your control can be more consequential than the ones you consciously take. That should soften your ego. Always expect to embrace the unexpected. That's what wealth creators do. This is the third time the phone is going off. I request somebody to please ask for $1,000 because we are financially very prudent. So whosoever, can you raise your hand? Your hand goes up. Can you raise your hand despite telling me twice this has happened? This is not acceptable in an institution like ours. So please, if you're coming from outside and if you violated that norm, as an ethical individual, pay $1,000 before you leave, right? And if any time the phone goes off again, we'll have to request you to leave the room, which is what we'll do in deference to our speakers. We want to hear them. The fourth element, in fact, the fifth element is do not be seduced by success. And I recall Bill Gates' words, who said, success is a lousy teacher. It seduces smart people into thinking they can't lose. They can't lose. Success is smart people whose phone goes off, they think they can't lose anything. They lose their reputation in the long run. If you don't know how to obey, you will not know how to lead. And so this is something that you will lose in the long run. You have to understand this. The sixth element is everything has a price. Just as we put a price of $1,000 on the phone going off. Everything has a price, but not all prices appear on labels. So don't lose your friendships, don't lose your connections with the community because you're getting richer. because that's the price you often pay for pursuit of wealth. And finally, modern capitalism provides two things. It generates wealth and it generates envy. Perhaps they go hand in hand. Wanting to surpass your peers can be the fuel of hard work, but life isn't any fun without the sense of enough. At the Harvard Business School, one of our training programs, we were asked to quote what was enough for us. What is your number was the name of the game. So we had to write what would be the maximum that we needed to call it a day and say enough. And this enoughness is very important. There was an author of Catcher in the Rye who made millions writing a book. It's a best-selling book. And he was told in a dinner party by one of the hosts that, whatever you earn, the millions that you earned selling a book for your lifetime was earned by a stockbroker in one evening. So what was the point of writing a book for a lifetime? This is one thing that the stockbroker would not take from me, can't take away from me, is that I have a sense of enough. He doesn't have it. He has to find it. He has to find it. And so you have to understand that life isn't any fun without the sense of enough. Happiness, as it is said, is just results minus expectations. Let me stop here and listen to our guest of honor and the address of Mr. Rao. I hope my students will take full benefit of it and remain sound-free from the phone point of view. I've done enough to tell you that we will not accept that as a way of life. And finally, thank you for your patience and kindness.
So we'll have some brief remarks from the four MDCO chairmen. Mr. Murali Ramakrishnan, may I request you to come first?
Am I audible? Yeah. Good morning everyone. Good morning dignitaries and dais and faculty members and my dear students. First of all, let me thank the organizers for giving me a great opportunity to be here. Wonderful topic for today and very relevant, very pertinent, especially given the fact that India is doing so well amongst the international economies today, and the topic can't be more relevant to India than any other country. I'm sure all of you must be tracking as part of your curriculum also as to how well the country is run today, and we are poised to be the fastest growing economy amongst the various economies, and many of the countries are facing probably their ever highest inflation in the last four or five decades, whereas India is looking forward to actually creating more and more job opportunities, more and more wealth, more and more institutions, and clearly we are poised to become a fastest developing country, and soon we'll probably become one amongst the developed countries. And it's already clearly evident from the fact that India is gaining a lot of importance today in the world arena with our Prime Minister now heading G20. I mean, these are all signals and sort of triggers to say that the world is looking at us. And I'm sure the recent success of Chandrayaan 3 and shows that what we can do as a country. And it's all done with in-house technology, in-house capabilities. I think in every single area today, India is doing so well. So in a way, I think all those students who are part of this great institute, I'm very happy to hear that this institute has surpassed, now it's among the top 3, which is fantastic news. I used to pass out from one of the IIMs, and we always used to say that the 4 IIMs are cut above the rest, but clearly that's a myth now. So with your institute now becoming top 3, I'm sure with a dean who speaks full of wisdom, I'm sure time is not far away when you will be counted amongst the best in the country. So I really wish the faculty here to really take this institute to that level. And so given this, I think you are all at a stage where you are fortunate to be studying, you are fortunate to be actually witnessing all these developments happening in the country, all the developments happening in the economy and in international scenario today. And I think these years which you spend in the campus, in my view, probably would be the best time for you to actually learn many things and really observe and learn from every possible source, because this is a very rare opportunity when country is doing so well and you actually passing out at that time is a great blessing. When I passed out in 91, just after that we had this huge Harshad Mehta scam, all that, and how much of sort of a derail the whole country got into post that is something which we have witnessed. And unfortunately, every few years we have had something or the other, and we had this 2008 crisis, a global crisis, which led to many of the countries going through their worst period. Fortunately, we weren't that much affected during that scenario. But all these are actually learning. As a student, you shouldn't stop learning after you pass out. You should continuously be learning all through your career, because the way things are changing, the way technology is creating a dent now in the way business are done, I'm sure your learning has to continue. And so I look forward to hearing from all of you as part of a Q&A session if you have after every session. And we'll be, I'm excited to be taking part in this seminar today. So I once again thank the organizer for giving me this great opportunity to share my thoughts with you. And I look forward to the day panning out with a lot more learnings for me personally. And wish you all the very best. Thank you.
Mr. Ravi, Mohan, please.
Good morning to all of you. Debashis, Shyam, Murali, Mr. Rajeshwar Rao, and Alexander, the Mridul faculty members, students. It's a great pleasure to be here. The last time I came here was in 2009, if my memory is correct. And that was a module which was done by one of my RBI colleagues, Dr. Balu. And I was speaking on the financial crisis. You know, 2009-10 was immediately after the global financial crisis and the regulation that was happening immediately after that. And now we are in 2023, after another crisis, which was the COVID pandemic. And if you look at the regulation at that time and this time, there is a substantial difference. In 2007-8 global financial crisis, banks were considered to be the propagators and the sources of that crisis, isn't it? The subprime mortgage, banks were the source of the crisis. They were propagators of the crisis. And the central banks or the regulators were also not seen in good light, because many of them, the supervision and regulation were not up to the mark. And what happened after that, all of you know, the regulation or the policy became very tight. The Basel III regulations came, liquidity, leverage ratio, macroprudential supervision, systemically important institutions, the capital buffers. So a whole lot of things which tightened the regulation came after that. So when this pandemic came, COVID came, banks were much more stable because of the regulatory tightening. And in this crisis, if you look at, if in the global financial crisis, banks were the problem, in the current pandemic crisis, banks are the solution, or banks were the solution. In many of the countries, it was banks which worked, where no other institution worked, and it was banks which tried to promote the lives and livelihood of people. Why? Because the regulatory regime had improved their capital, improved their liquidity, improved their overall functioning, and they had enough cushion to lend and do these activities. In fact, I will say that after the COVID-induced crisis, it has been exactly the opposite what happened after the global financial crisis. There has been relaxation or liberalization of many of the things, but within the remit of the Basel Committee requirements and the requirements of the international regulators and supervisors. So this is a very critical time when not only the Reserve Bank of India, but every other regulator has been working very closely in a systematic manner so that the regulation and the supervision of the financial institutions are up to the international benchmark. And it is in this context that we see the Indian regulation and supervision. And for heading this regulation department in India, at this point in time, there cannot be a better person than Rajeshwar Rao. And I will say that with a lot of personal experience with him, because September 1983. September 1983 was the month when both of us were selected in RBI. But even before that, we studied together in Maharajas College. So it's a relationship running for more than how many years? We both have lost count. So and working together for more than 40 years, knowing together more than 40 years is a great thing. And we all worked through my most of my career in RBI I spent in regulation, and toward the end in supervision. He spent in financial markets and then came to regulation. And whatever the regulatory initiatives that the Reserve Bank has been doing has been his what I will say his initiative. But in regulation, I will also talk about a couple of things and then stop. Basically, there is a what I will say the objective of regulation. If you look at it talks about protection of depositors' interest, then financial integrity, financial stability, customer protection, all these things. But there is also a very close relationship between regulation and the markets and the innovation, because you have some trade-offs in regulation. One of the major trade-off is regulation and innovation. Always when you try to innovate, the market participants feel that regulation comes in the way, and they will try to do something. Maybe they are ahead of the regulation, and the regulator will try to fix that. And too much innovation will spoil the financial system, and too much regulation also will spoil that. So how do we create a correct balance? I am sure that Mr. Rao, with his experience in financial markets and regulation, is going to talk very surely on that. And of course, the colleagues who are there in the panel, of course, Murali spoke earlier, and there are two more people. Of course, Shyam has been with the Federal Bank. Of course, I had the opportunity of supervising the bank when he was there and when I was in charge of supervision department. And of course, Mr. Alexander, I meet him in all these type of seminars. Last one we spoke together was in that Dhanam BFSI conference, and with their rich experience, I am sure that they will also touch upon all these things. And I am sure that after that we have the panel discussion where some of these things can be spoken in detail. So thank you, IIM Calicut for Kozhikode for inviting and giving this opportunity to talk to you. And I am sure that this is going to be an enriching event for you, and you will go back thinking of many things which you have not thought about earlier. And that should be the attitude, that should be the outcome of any of these type of seminars. If it can kindle some interest in you to think about some things, that the objective of this seminar will be fully satisfied. So thank you very much.
We'll now request for brief remarks from Mr. George Alexander Muthoot, is MD of Muthoot Finance.
Thank you. Good morning to all of you. The respected stalwarts on the dais, the students, other dignitaries who have come for this seminar. Today, the seminar is about banking regulation, the soundness and systemic stability. First time, we, Muthoot Finance, we are a non-banking finance company. All the others here are bankers. I am the only non-banker here, I think so. Either they are regulators or they are scheduled bankers. I am the only non-banking. And sometimes I also feel that the nomenclature which starts with a non-banking is definitely a negative connotation. You start with non-banking. What is this non-banking? So anyway, that is something for the regulators to decide whether we should be called as financial companies or non-banking companies. That apart, I'm definitely very happy to be here. Probably I came here 10 or 12 years back. At that time, your director, Debashis Chatterjee, was here. And as I just spoke to him in the morning, he was saying, a sea change has happened here. Definitely, a sea change has happened in the last 10 years here. No doubt about it. The IIM Kozhikode, which I see today, is much changed than what I saw maybe 10 years back. And definitely congratulations to his leadership and the faculty here for, as he said, for being the third rank in the IIM. That's a big, big order for a Kerala-based IIM, and also all congratulations to faculty and the students and to the director also. And about here, when we say about regulations, etc., I agree with the earlier speakers who said that Indian or the Reserve Bank, who is regulating the financial sector here, have definitely done a good job. Of course, we in BFCs also sometimes go and complain. We go and crib with the regulator that this should not be done like that, this should be done like this. But then when we look at the long or the future picture, we see that many of the things which the RBI has done or seen to be doing is definitely good for the sector. So the stability of the financial sector or the financial markets in the country is certainly very good, very essential. You would have seen in even the Western countries, many of the Western countries also are facing big financial crisis today. There is inflation, etc., which is not there in many Western countries. My brother, who is a doctor, eldest brother, is not in the business though. He's in New York for the last 50 years. So whenever I used to talk to him, till about 3 years back, he used to say, the price of bread, milk, eggs has not changed in New York for the last 40 years, he said. It's the same price. But in the last 1 year, it has started increasing. That is what is now pinching the Western economy. They also do not know what to do. They are increasing their lending rates. They are increasing their benchmark rates. Where it was 0.5, it is now 4% and 5%. If you, from 0.5 to 5% is actually a, how many, 10 times increase. 10 times increase is the benchmark rate. So there is a lot of confusion there, but fortunately in India, there is no such big confusions in the financial market. Certainly, the topic which we chose today is certainly good and relevant, and I'm sure the deliberations going forward would also be good. So one more thing, since I'm here about NBFC, I'm the only one in the NBFC sector here. In the lighter vein also I would like to say, earlier in the last several years, always the regulator used to say, NBFCs have a regulatory arbitrage. That means regulations for NBFCs are much lesser than the scheduled banks. You have an arbitrage, you have the advantage. But in the last few years, in the last 5-6 years, that regulatory arbitrage is no more there for NBFCs and definitely no more there for the upper layer NBFCs. So Muthoot Finance is also treated as one of the 16 upper layer NBFCs by the Reserve Bank of India. Last week, there was a meeting called by the governor, and the deputy governor was also there in the meeting. The main focus there was the NBFCs, upper layer NBFCs, have also to become like or be regulated as much as a scheduled commercial bank. So that's the way the regulator is looking at this. Of course, they have soft touch regulation for smaller companies. For very small NBFCs, they call it soft touch regulation. But when the NBFC becomes big, and as you say, you have system here, systemic, so systemically important. So when the NBFC or the bank or the financial institutions become systemically important, that's the topic of your discussions also tomorrow, the regulations are much tighter because they can impact the whole financial system. That is what the regulator means by that. So I think that the topic chosen here today is very relevant, and I'm happy to be part of this and happy to be called here and also happy to be part of the panel discussions in the afternoon. Thank you, and may you all have a good and enlightening seminar in the hours to come. Thank you.
Mr. Shyam Srinivasan, not last the least, but last the most. Please go ahead.
Thank you and good afternoon, good morning, everybody. friends in the dais, Honorable Deputy Governor. It's an honor. Being the last speaker after 3-4 of them, it's very difficult not to repeat them, right? So I have to try and invent something which is new, different, and different from what Deputy Governor will say, which is very hard. Firstly, I just wanted to mention, first we must give the Governor a round of applause because that is a message in that. Governor is getting it, but I also think it signifies what India is doing and the RBI is doing. So I do think it's a great commentary on India. When George was speaking about regulatory arbitrage, a couple of days back I was in another program, and where they had asked me to envision what Indian banking will look in 2035. I took the liberty of creating a few themes, and one of them I had said, regulatory arbitrage will fast disappear, which it is, and I think George mentioned it, and I do think it is true because Ms. Ravi Mohan mentioned that the fine balance between regulation and innovation is actually the challenge, right? I always believe innovations happen on the fringe of regulations. People try to create that little window and create something new. So how does the regulator use all the forward-looking practices and bring about regulations that are not backward-looking but forward-looking? And there's a difference between deregulation and control. And I do recall in the early 90s when Mexico was in this binge of growth. So they fancily deregulated literally, and then we all know what happened in a 5-6 year period. The country just almost went bust. So I think India has done a remarkable job and the RBI has done a remarkable job of being ahead on most instances and trying to ensure that India is in this so-called sweet spot that we are at this point in time was not by accident. I think it is a conscious outcome of a design, and I do believe regulatory arbitrage disappearing, using technology to ensure that regulations are both contemporary, sometimes forward-looking, but yet enabling. And I do think that's the enviable task or the tripod that Mr. Rao is definitely working on and continuously looking at. The only thing in that is it's a continuous dialogue. I don't believe it's unilateral consequences. It has to be constant dialogue, and I'm sure when RBI calls us, the private sector banks, the public sector banks, the NBFCs, for almost like a 6-monthly dialogue between the seniors of RBI and the bank MDs, you know that that conversation is happening. So the first point I'd leave you is regulatory arbitrage is fast disappearing. But we must also keep in mind India is burgeoning in the whole tech-enabled, fintech-enabled space, and that's going to be quite a challenge because, like I said, you can't curb innovation, and fintechs are exploding and will continue to explode. And the nature of the country is to ensure their interests are fanned and grown because that's what helps the other aspect of India, right? We need innovation and inclusivity. India cannot grow without inclusion. So I think the short point I would leave with regulatory arbitrage, the burgeoning of fintech, which is exploding, to enable innovation and inclusion happens. So in some sense, if you see R is regulatory arbitrage, B is burgeoning of fintechs, and I is innovation and inclusivity, is RBI. So I would only say that today's session is beautifully constructed, Mr. Saggar and the entire team, to help have a conversation on how RBI is keeping the system sound and ensure both innovation and inclusion are happening, and yet not a runaway problem. So good conference. Thank you very much. Have a great conference. Thank you.
We'll now request Deputy Governor, but before that, may I request Director to greet him with the bouquet and our other guests with the bouquets.
morning, everybody. Delighted to be here in Kozhikode and continuing the talk on nostalgia which Ravi Mohan started. I was just mentioning to Professor Debashis that it's almost 56 years since I've actually come back to Calicut. It was known as Calicut in the days when I left. In fact, I started my schooling in Calicut, so it's always a nostalgic trip back here. I'm very happy that IIM has chosen to invite me for this interesting seminar conceived of by Dr. Mridul Saggar and his team. So thank you very much once again. Professors, other distinguished guests on the dais, professors and students. I'm delighted to be here to share my thoughts at the occasion of this seminar. And in a way, I thought that Professor Chatterjee and Ravi Mohan actually set the tone for this points which I thought I would have to make. In the sense, he talked about the requirement of financing on an extensive scale for development of our country, when you mentioned about the financialization. And I think Ravi talked about the role regulation played in transforming the banking sector from being the originator of crisis in the 2008-9 period to being the bulwark or the support for managing the outcomes of the COVID pandemic in the 20s, thanks mainly due to the regulations which built up the capital and liquidity buffers and enabled the banks to play a crucial role at this very critical moment in our history. So this theme of this seminar quite aptly sums up the two key objectives of banking regulation. That is enhancing resolution of the institutions, but while maintaining financial stability. So in my address, to build on the theme which as highlighted by the professor and Ravi, I would like to dwell in detail about an aspect which has a critical bearing on the soundness of the banking system. That is effective and de-risked credit intermediation. While credit intermediation in some ways describes and defines the role of banking system in an economy, it also acts at the same time as a key channel for effective monetary transmission and greater financialization of the economy. However, if it's not regulated appropriately, this channel can prove to be the undoing of the institutions and therefore become a source of broader financial instability. Therefore, the bank regulation and soundness of financial intermediaries are necessary conditions to facilitate orderly credit growth. This therefore brings up a few issues and challenges in designing prudentially sound boundaries for the same. In this context, I thought I could share some thoughts on the need to have robust credit markets and the way forward. That is why I have titled that speech as credit intermediation, can regulations tango with the markets? Because markets and regulation normally don't tango with each other, they are just kind of mirror opposites of each other. So I'll start with the issue of financialization. What do we mean and how is it relevant to us? I will start with trying to give a flavor of the scope for financialization of the economy. Whenever we refer to financialization, in popular parlance, it is understood to mean that expanding role for financial markets, financial actors, and financial institutions in the operation of the economy. Since independence, our economy has grown substantially, reaching the status of the world's fifth largest economy today, even as we set up ourselves on course to become the third largest economy in the world by perhaps the end of this decade. This growth trajectory has been enabled and supported by a multitude of factors, including greater entrepreneurial spirit, policy reforms, structural economic changes, and development of institutional structures. Effective financialization has been a key enabler in this journey. This has been facilitated by the growth of financial institutions in terms of institutional outreach, the last mile presence, and availability of banking services over multiple channels. Expanded bank presence across the country, growth of non-bank financial intermediation, and the concomitant efforts of authorities to further financial inclusion and democratize credit have aided this process. The concepts of doorstep banking and banking correspondence have revolutionized the idea of financial inclusion per se and facilitated overall deepening of the financialization in the India. More recently, the evolution of fintech entities and their interplay with the formal financial system has been instrumental in transforming the way financial products and services are delivered to the masses. However, the changes have also brought forth several challenges in using the existing and conventional approaches for regulating these activities, which is an issue which we as regulators need to address. Now, coming to the issue of credit growth and its role in financialization and the need for orderliness, this is what I thought I would like to first begin my focus on. We'll start with the word credit. It has its genesis in the Latin word credere, which means to entrust. The financial usage of the term credit also borrows the same idea of trust, where money is given to an individual or entity on the trust with the expectation of getting it back with some reward in the form of interest. Of course, for the financial entity, this trust rests on both sides of the balance sheet. The financial institutions, for example, the banks, are able to raise funds from the public as the latter trust the institution to repay the deposits. At the same time, when these entities lend funds to their customers, they must be able to have a similar degree of confidence on trust on the repayment capability, the willingness and abilities of their borrowers. Hence, the money flow in the system is based on mutual faith. The idea of financialization and its success is built on this edifice of trust. There have been several studies which establish that credit plays an important role in financialization. Empirically, too, it is observed that the growth of GDP in India and the credit flow to the commercial sector by the banks are positively correlated with each other. Over time, the growth in credit flow has also outpaced the growth of the economy, contributing increasingly to facilitate availability of capital to the productive sectors of the economy. To give some perspective on this growth, let us say that I would start by mentioning that the credit to deposit ratio, which was in the range of about 7 to 8% in the decades beginning 1960s, has increased significantly to around 55% by the end of this decade. While acknowledging the impact of financialization, let me also focus a bit on how the changing components of credit markets have larger implication for financialization in India. The traditional form of credit involving loans extended by financial institutions have dominated the credit markets in India, but of late there has been an upswing in other forms of credit instruments. The market-linked instruments such as corporate bonds, debentures and commercial papers in particular have manifested an upward trend. Data indicates that while the banks still account for a large proportion of the credit flow to the commercial sector, the other sources of borrowing such as from non-banks or through corporate bonds and foreign exchange borrowings are also showing a rising trend. In a way, these developments are not purely organic. In fact, there have been some regulatory nudges for deepening the financial sector and diversifying the source of credit. Now, this also begs the question that if credit growth-led financialization alone can drive economic growth, can we deem that to be a panacea for our development? Should our only focus be then to increase credit growth as the driver of economic growth? This, in my view, is unlikely to be the case, as there could be two major consequences of an excessive expansion of credit in an uncontrolled and unregulated manner. First, it may lead to a buildup of an excessive leverage in the real sector, and second, as often experienced, periods of excessive credit growth leads to excessive risk-taking by the lending institutions. A combination of these two factors may lead to a systemic crisis and endanger the financial and systemic stability. In addition, this also has a significant influence on the broader aspect of trust in the financial system. We had learned this the hard way during the global financial crisis of 2008, when unbridled credit expansion led to a banking sector crisis and later manifested into a systemic crisis. If the process of unchecked credit growth leads to growth of money above the level of comfort of the monetary authorities, there would, of course, because credit growth, the opposite is it's one of the sources of growth of money. There would be concerns around controlling money supply and transmission of monetary policy impulses, and may hinder the achievement of the broader objectives of price stability. Therefore, it is not just the unqualified or the unconditional credit growth which is crucial for economic development, but orderly credit growth which maintains and anchors financial stability in the system, and that in turn ensures sustainable growth over the longer term. So this actually justifies the need for regulation of the credit markets. Given the size of credit portfolios of financial institutions and the large share which the credit risk plays on their balance sheet, it's imperative that any strategy to maintain the financial stability in the institutions and systems need to consider credit risk at its core element. Now, despite the growth of other market-led instruments which I mentioned earlier, the risk-weighted assets to the total banking assets has, been in the range of about 86% in 2015. It has just come down to about 82% in 2023. It has been more or less in that range throughout this period. So credit risk is an important component which needs to be addressed. So if we delve a little deeper into the landscape of credit risk, it's apparent that there are three fundamental elements which need to be factored in. That is trust, prudence, and contractual arrangements, which are also mutually interconnected. Information asymmetry may result in vulnerabilities despite having due contractual arrangements in place, which can potentially impede the process of credit intermediation. Regulatory frameworks and policies come into play here, and our regulatory policies require well thought out frameworks relating to credit appraisal, due diligence, recovery, and resolution in order to overcome this trust deficit or compensate for it in some manner or the other. The policies seek to ensure that the risks associated with the lending business are prudentially measured, managed, and provided for. From the perspective of this thematic seminar, let me focus on the prudential aspect of credit risk management, for which we have a principle-based regulatory approach. To describe our approach in an engaging manner, let us call it a 5M framework for risk management, which focuses on the following 5 elements: measuring, monitoring, managing, mitigating, and migrating. The elements of this framework are not mutually exclusive and interact with and relate and reinforce each other. Just to elaborate a little bit on each of these elements, let me start with measurement. Peter Drucker, the famous management expert, once said that if you cannot measure it, you cannot manage it. I believe this to be an universal principle, and banking regulations around risk management also follows a similar approach. In order to measure credit risk, all regulators around the world, including the Reserve Bank, have prescribed detailed guidelines to enable a proper measurement of the credit risk aspect. The second M would relate to monitoring. This aspect of credit risk management largely relies on monitoring and oversight exercised by the financial institutions through their policies, which have to be dovetailed with the prudential norms prescribed by the regulators. The concerned financial institutions are mandated to frame prudent policies on risk management, governance, compliance, to cite a few issues. These norms are intended to overcome any inherent moral hazard in the system. There are usually 3 layers of internal checks prescribed for the institutions. First, underwriting and due diligence at the time of origination of the loans. Second, adherence with internal risk management and compliance practices. And the third, internal audit. These issues are examined by us as part of the supervisory oversight process, wherein apart from assessing the efforts of the financial institutions on these parameters, the supervisors also assess if the general or other provisions maintained by the bank truly reflect the inherent risk. The third M refers to management. Factoring in the risk and reward payoff, the financial institutions may prefer to bear and manage some risk as part of its risk management practice. This would essentially be a business call. But in order to ensure that the regulated entities are well capitalized in proportion to the risk they are carrying, the regulators across the world prescribe capital adequacy norms wherein minimum regulatory capital is provided by the banks based on certain principles. This then becomes the first level of risk management wherein the risk is absorbed internally and adequate capital is provided for the same. Besides, the pricing of credit also influences this risk-return trade-off. Then, of course, mitigation of risks. If the risks taken by the financial institutions grow beyond its comfort zone, that is, its risk appetite, then they may have to manage it actively rather than merely absorbing it. This risk mitigation is enforced at two levels. First, by the regulators, which is mostly prudential in nature, like provisioning norms or exposure limits. Second, at the institutional level, where the institutions themselves may prescribe exposure limits to manage concentration risks or put certain collateral constraints on borrowers or prescribe stringent covenants to manage the risk. In addition, financial institutions may also deploy permitted credit risk mitigants such as loan guarantees, collateralized transactions, on-balance sheet netting, etc. to mitigate the credit risks. Finally, let me come to the issue of migrating the credit risk. This involves the risk of taking it out of the bank's books. There could be several tools available for transfer or migration of the credit risk, but I am going to touch upon two of them. First, and probably the most popular way, is to simply transfer the asset or the loan and associated risk to another entity. In this method, the financial institution concerned may prefer to transfer a single loan or a pool of loans to a willing eligible party through bilateral arrangements or otherwise. The economic risk gets transferred from the books of the transferor to the transferee. The second option is by way of securitization. In this arrangement, the originator of the loan selects a pool of loans and transfers it to a special purpose vehicle which securitizes the loans and sells the securitization notes to a diverse set of investors. This method diversifies the nature and concentration of credit risk in the system. In case of most of the credit risk management tools, especially for credit risk transfer or migration, the role of markets is extremely important. If the lender concerned prefers to transfer its risk, it will invariably require a deep and vibrant market in which it can offload its exposure. Transferring the economic interests along with risks or securitizing the assets through the special purpose vehicles requires participation from a broad base of institutions who have to be on the other side of the transaction. A deep market will not only facilitate this transaction smoothly, but it will also assist in fair pricing of such assets. This issue, therefore, has been an area of focus for the Reserve Bank, that is, to develop enabling frameworks which facilitate a smooth migration of credit risk from one entity to another. Let me briefly touch upon a few of these initiatives. While the methods of credit risk management described above will not be exhaustive, they broadly cover different themes of risk management practices in India and the world. Reserve Bank has been making concerted efforts to provide enabling frameworks for our regulated entities across these themes. The regulations around management and migration of credit risk are already quite robust and have stood the test of time. However, as a part of our recent regulatory initiatives, we have focused on policy measures to improve the mechanics of migration or transfer of risk. In September 2021, we came up with a revised set of guidelines for transfer of loan exposures and securitization of standard assets. These frameworks were developed after a wide consultative process to incorporate market expectations, and these policy measures are aligned with global standards to ensure that the credit risk is managed effectively in the system. As we also need to ensure that these such important initiatives are flexible in their design, we have also established an internal mechanism to review the frameworks at regular intervals to assimilate market feedback, market developments, and comments from various participants. Similarly, The guidelines for credit default swaps have also been comprehensively revised in 2022 to facilitate development of markets for CDS by expanding its participants base. Besides banks and foreign portfolio investors, the regulations permit selling of protection through CDS by all major non-bank regulated entities subject to regulatory approval. It is pertinent to emphasize that while our guidelines on transfer of loan and securitization cover loans in general, CDS guidelines cover money market instruments and also corporate bonds. This makes it a complementary tool of risk management for two different and important credit instruments, loans and corporate bonds. Let me share some perspectives on the way forward. The credit market of the future is likely to be nimbler than what it is at this point in time. Maybe it will also be deeper. The CDS markets even today are considered fairly shallow, but they transmit a very powerful price impulse signal which can actually trigger problems in large financial institutions. We would also need to have dynamic secondary markets for loan instruments, a wider base of participants and asset classes in the market, and a robust framework for risk assessment. Based on these enablers, it may be possible to ensure smooth interaction between the different players in the credit markets and efficient allocation of resources to the real economy, while providing the tools to financial entities to de-risk their balance sheets. An efficient market also reduces frictions in the financial system. The growth of markets in an orderly manner is necessary to address the twin challenges of ensuring smooth credit flow with robust risk management. To develop credit markets for trading of loans, Reserve Bank facilitated the formation of a secondary loan markets association in 2020. The SLMA platform, which became operational in 2022, has onboarded many major banks and is in the process of onboarding other major players, including the non-bank financial companies. The basic idea of this platform is to enable easy risk transfer of loans at a fair price, devised through market-based auction mechanisms where the quotes are obtained from all interested parties rather than selling the loans through bilateral arrangements. A deep and active secondary market, which is envisaged to be developed through the SLMA, would be crucial to impart fairness and transparency to the transfer of loans and credit risk among market participants. Conventionally, the credit market in India has been tightly regulated, primarily driven by the need to ensure banking and financial stability. However, it has been acknowledged that permitting a diverse set of participants in the markets may actually help to make it that much more vibrant and efficient. Therefore, the Reserve Bank took the first steps of liberalizing the credit markets by allowing entities outside our regulatory purview but regulated by other financial sector regulators to acquire stressed loans under the transfer of loans exposure framework. Similarly, for standard assets, the securitization framework permits a diverse set of investors to subscribe to securitization notes on the underlying loans. By having a wider set of participants, it's envisaged that the credit markets will become more vibrant, effective, and transparent. The markets for securitization products is quickly catching up in India and is poised to grow manifold in the years to come. Our framework on securitization issued in 2021 carries a negative list restricting a few asset classes from being securitized. But this is not a fixed exclusion. We constantly monitor the growth and maturity of markets and are ready to take a well thought out call if some restricted assets could be securitized in the current environment. To sum up, while credit is an important driver for the growth of an economy from the financialization perspective, we need a robust risk management framework to manage credit risk. The array of tools for credit risk management have evolved, with prudential limits providing a regulatory backstop. To facilitate transfer of credit risk between entities in a fair and transparent manner, several policy enablers have been put in place by the Reserve Bank of India with the objective of developing robust credit markets. As you may have observed, the discussion of risk was at the core of my deliberations today. As a regulator, we do acknowledge that risk cannot be avoided. After all, the risk and reward dynamics is the soul of the entire edifice of finance. It may be appropriate to recall a few lines from a famous poem, Risk, by the poet William Arthur Ward. To hope is to risk despair. To try is to risk failure, but risks must be taken because the greatest hazard in life is to risk nothing. So some risks must be taken. However, it is in our collective interest that we know the risks we are taking, assess it adequately, and acquire the capabilities to manage it. Thank you.
Thank you. That's a very, very illuminating speech on a very, very important topic. May I open the floor for Q&A and maybe give the first chance to anybody from the panel on the dais? Some questions? Yeah. Okay. Anybody from the panel before we sort of ask the floor to ask any questions?
So thank you. That was very useful. One question that always is in my head, and I'm sure I refer to in my speech, how do you keep this constant struggle and balance between how much innovation you permit and when do you pull back? And is there a mechanism in which you're constantly evaluating? But like I mentioned in another platform to you, this whole fintech space is exploding, and a lot of stuff is happening. And some of us bankers have worked very closely or collaborate with the fintechs. And within available frameworks, we think we are in doing. But the local supervision always tends to view that practices are a little edgy. Where do you draw the lines? How do you look at that?
That's a very actually tough question to really give a very precise answer. I think it's like the Goldilocks porridge, I suppose, just right. You need a flavor for that. But from a regulatory perspective, when I look at regulation, what I try to, vis-a-vis innovation, the first point of which you made, I'll try to look at regulation as like kind of a speed breaker on a road, especially around a sharp curve where you put the speed breaker with the intention of slowing down the traffic, not stopping the traffic. So it protects the driver, it protects the public also. So that is the basic objective with which the regulatory frameworks are trying to be framed or evolved. And wherever it is required, we do have an elaborate consultative process which engages with the various people. Like when you come to the issue of fintechs, we did set up a working group on digital lending, which went into the whole issue at depth with a lot of market experts in the entire process. Once they came out with the recommendations, we tried to frame regulations, and the focus of the regulation has been not to stifle innovation, but to ensure this entire edifice of digital lending happens through a regulatory framework. While we may not have formal regulatory power over some of the fintechs, but we said that if they are going to offer financial services, they have to happen through the regulated financial entities, and the discipline of the RBI norms in terms of customer protection, in terms of fair treatment of customers, etc., should happen through the mechanism of the regulated entities. So that has been the focus largely in terms of what has been framed. And that tends to drive the entire process. So while we are not, we are not anti-technology or anti-innovation. In fact, I think innovation is something we have to live with. Fintechs have done a wonderful job in actually expanding the reach of financial inclusion to the nooks and corners of the world. Perhaps what a brick and mortar presence could not do, it is done through the fintechs. But at the same time, customer protection, fair treatment of customers, sharp practices in terms of recovery, those are key issues which need to be addressed, and that has to be done and enforced through the regulated entity, which is actually the one responsible. So we'll hold the regulated entity responsible in terms of what it needs to do.
If I had to say that the regulator would like to see that all lending happens through a regulated entity only. Is that so? I think so.
I think since we have been entrusted with the task of ensuring a fair treatment for the customers, obviously we would like to...
No, I'm not saying that it is wrong. I say that is what it is. So finally it will come to, if you want to lend, it should be done through a regulated,
exactly.
Either a bank or a non-bank or whichever. Is that it?
Yes.
So you wouldn't, the reservoir wouldn't like, not you, the regulator wouldn't like somebody to do a lending who is not having overall supervised or not supervised by the regulator. I think that's the sum and substance of it.
Yes.
My question is a little basic, sir. As a technology is today influencing financial markets, be it lending, be it insurance, be it many other areas. Now, with the regulators being available for each of these sub-segments, do we really see a timeline where all regulators will be together coming up with a common guideline, because digitization is something which is now cutting across various financial services. So how far, is there any thought like that? How far are we from such thought emerging where common guidelines, because technology is going to be sort of overriding many of these aspects?
No, I think maybe to begin with, if you look at our guidelines on fintechs, the digital lending guidelines, the press release did talk about having the other regulators also to consider similar norms. That was the basic intention, because the group studied the issue of fintechs and identified the problems and the challenges and certain norms which they felt would be necessary, largely from the area of customer protection and good customer recovery behavior, etc. So we said that we will make it applicable to our regulated entities. The idea is the other regulators will make it applicable to the other regulated entities. So when it comes to fintechs, while the financial products will vary and the regulators may vary, there may be certain common standards which will have to be followed by all the regulators and enforced on the regulated entities which they are regulating.
Alexander sir was talking about regulation of lenders. So can you also throw light on peer-to-peer lending? So do you think peer-to-peer lending should be banned, or how should it be regulated? There's a problem of trust, because of which even government has recently banned a few fraudulent apps which were into peer-to-peer lending. So how do you see that growing? Should it be encouraged or not? Thank you.
No, P2P lending, if you look at it, RBI already considers it to be a non-banking financial company, and there are certain norms for non-banking financial registration of peer-to-peer lending platforms, which they have to comply with in terms of capital and in terms of technical standards and other aspects. So it is already a regulated area insofar as RBI is concerned. And there has been some amount of growth in the P2P lending platform. The volumes are not very large, and there tends to be a dominance of the one or two players in this entire edifice. But there could be concerns that it is essentially a platform where you marry the lender with the concerned borrower. A private person puts some money. It should not become an edifice to take advantage or create what is a regulatory arbitrage. That is one point which, as a regulator, we would be very concerned with, and we would be quite, aggressive in taking appropriate action if we come across such instances.
So my question is on credit growth outpacing economic growth. How desirable is that, especially with capital infusions into the banks?
No, see, if you look at it, the context in which I made that comment was the fact that when we looked at financialization of the economy, in India, the financial sector had a ratio of about 6%, 6 to 8% of the GDP in 1960s. It has now come to close to 55%. But there are advanced economies where the ratios are well above 100, 150%. So where do we draw the line? So the point is, an expanding role for the financial sector is important, both from the perspective of inclusion, bringing larger number of people in the ambit of the financial services, within the ambit of the formal financial services, and also in terms of democratizing credit. So as I said, the fintechs of the world perhaps will actually have a critical role to play in democratizing credit, but only thing is, it has to be calibrated or managed in an orderly fashion so that it doesn't become a demon which comes back to bite you. So that is the challenge which we would have to handle as a regulator.
Good afternoon, sir. My name is Sophia and I'm a PhD student in the economics area. So the RBI has pilot tested its central banking digital currency, the e-rupee, and now there is interoperability with UPI as well. So my question is, are we expecting an extensive deployment of the e-CBDC or retail CBDC? And what are the kind of regulatory concerns around this area?
No, I think at this point, the CBDC essentially is being experimented with at this point. So what we are doing is we are gradually expanding the number of people who are involved in the system, the number of transactions which have to be done in the CBDC to test the robustness of the entire process, what are the shortcomings. So it is early days in the entire trial period. So right now, I would say we are just carrying out a trial and no decision on how to include, in what way to include it in the system has been taken at this point in time.
Good afternoon, sir. Um, Western countries have been in the business for a very long time, but still India is praised as one of the robust economies. What is India doing right that other countries are not able to do so? Is it due to the regulations or any other external factors? Or is it due to the savings mindset of Indians versus the expenditure mindset of Western countries?
Anyway, again, another very tricky question, I would say. But I think growth has happened as a natural transition for India. India is a developing economy. The growth is happening. There is a large pent-up amount of demand. A lot of investments are happening. And today we are fortunate that even during the COVID, a large degree of fiscal prudence was maintained by the government in terms of spending. And now any step up of the government expenditure has largely been in the capital expenditure front. So investments is happening. There has been continuous pent up demand within the economy that has actually, created demand for goods and services that has encouraged growth in the recent particular time. And banks have been actually, after the asset quality review and extensive provisioning, banks are looking fairly healthy and they seem to have the resource ability to grow robustly at this point in time. So all in all, I think we seem to have been in a sweet spot at this point in time to grow very robustly. But of course, there are dark clouds in the horizon, not literally, but perhaps in the economy there could be some challenges which we could face. Particularly, I don't know how the monsoon will pan out because that is going to be a key variable in the way our economy grows in the next 1 year. So we'll have to wait and watch. But whenever we are growing, while we are growing and the position looks good both from the fiscal perspective or from the financial stability and the banking stability perspective, with a minor spike in inflation, especially seen around the vegetable and other prices. But I think what we need to do is look at the whole thing with a fair degree of caution, because we need to be prepared to handle any unforeseen consequences. So we have to be on our guard, and this is exactly the message which I think our governor has been continuously talking. He has been talking to the bankers, he's been talking to the non-bank financial companies, and this is the message that when the going is good, you have to be very cautious, and that's the message which we are trying to convey to the entity. So we should not allow for a runaway growth which can create a inflationary spiral in the country.
So we have run out of time, but there's a pressing from last question maybe.
Good afternoon, sir. So my question is that India is facing some recent increase in inflation. That recently we have 7%, 7-8% of inflation, and RBI is doing its regulatory work to contain this inflation. So recently RBI came up with a intermediary solution to contain inflation and drive out the excess cash or money from the market by introducing excess CRR on a specific period from May 19 to July 28, and that is 4.5% CRR. So how RBI came up with this decision and to drive out the excess liquidity out of market? Thank you.
I think that decision on liquidity is handled separately, but I think, see, when we look at the monetary policy, the focus has been on withdrawal of accommodation at that point in time. And in the recent times, we found that a huge amount of liquidity had been infused into the system because there have been forex inflows, there has been some other government spending, etc. So, and RBI also had given a very healthy dividend to the government this year. So, a lot of excess liquidity was there in the system, and we felt that consistent with the stance, if you need to, there is an excessive growth of deposits, so maybe there is a need to contain liquidity at this point in time. So, a decision was taken that there is a need to impound the excess liquidity for a very short period of time, because it then unwinds itself. After maybe the first week of September, there will be pent-up demand for goods and services, government expenditure, government tax collections would happen. there will be increased demand for what you call currency in circulation for festive spending. All those things will actually drain out the liquidity. So at that point, it can be, the liquidity could, what do you call, right itself. It comes back to its normal level. So this was thought of as a temporary measure to address the temporary spike in liquidity.
Yes, indeed, that was a very, very timely measure considering the drought effects would now come in and excess liquidity can actually hike prices a lot more. But I'll request Professor Rotse and Shyama to do vote of thanks now.
Thank you. As a member of the Center for Macroeconomics, Banking and Finance, it's my honor to propose a vote of thanks. So first and foremost, to Shri Rajeshwar Rao ji, on behalf of IIM Kozhikode, I express our deep gratitude to you, sir, for coming down and giving us your valuable insights on the tango between markets and regulator, as you mentioned that. So it's very interesting to hear about the importance of financial inclusion for economic growth. And in that connection, the 5 M's, we usually hear of 5 C's in bank lending, but 5 M's and risk and securitization, and therein the importance of regulation. And thank you for taking questions also from the audience. Thank you to all the other invited guests, and I think most of them will be there in the afternoon, so we'll hear from you more in the afternoon. But thank you for your opening remarks, Shri Murali Ramakrishnan, Shri Ravi Mohan, Shri George Alexander Muthoot, and Shri Shyam Srinivasan for being here. Let me thank our director, Professor Debashis Chatterjee, for being a pillar of support and strength to the Center of Macroeconomics, Banking and Finance, and also for supporting this event from the very beginning and gracing the occasion. Thank you to my colleague, Dr. Mridul Saggar, who heads the center, and all other faculty colleagues for supporting us. Also express my gratitude to the fantastic job done by General Administration, Colonel Manta and his team, and all other administrative departments, Director's Office and various other departments, SS Office, etc. for supporting this event. And finally, thanks to all of you, audience, without whom we will be speaking to the empty chairs. So thank you for coming here. We'll close the session now and look forward to seeing you back at 1:45. Thank you.